This is Pranav Rao from Smartkarma, and I'm pleased to have with me my namesake, is Pranav Bhavsar, to discuss his recent insight on Kalyan Jewellers. Pranav, thanks for your time today on the 14th of August. Could you briefly introduce the company and talk through some of the key questions that arose to you following the company's last earnings call?
Yeah, hi Pranav. Nice to speak to you again. Before I introduce you to the company, just a quick little bit disclaimer. We are SEBI-regulated analysts with no positions in the stock, nor there is any interest in taking any positions in the stock. We do not also give any buy, sell, hold recommendations, and our services are predominantly for institutional investors only. So with that disclaimer, I will just quickly introduce you to Kalyan Jewellers. So Kalyan Jewellers basically is a jewelry retailer. Most people who track India would be aware of a large listed peer called Titan. So they have a similar business. They run jewelry stores across country. And one of the things that they have been doing off late is they have been focusing on painting this narrative about franchisee-owned, company-operated, asset-light business model, which caught our attention. Shall I go through these questions that you had put forward for me over the email?
Yeah, sure. I think before that, the reason you're in your car today is because I believe you're right in front of one of their newer
Yeah.
initiatives.
So
Go
if you
ahead.
can see Kandahar, which is a little bit of a problem for us, we're not happy with this type of expansion. So which is
Got
why I thought it's a good idea to throw some perspective here as well.
Got it. So maybe we can just touch on that, right? I think one of the things you highlighted in your note was this incongruence between being asset light and the margins Kalyan Jewellers reports versus his peers. Can you maybe talk through that a little further?
Yeah, before we get on to the margins, Pranav, what I would like to tell you is what really caught our attention on this particular call and why this is of importance. So not just this call, but if you recall around Q3 FY25, where the management gave some color on the type of franchising partners that they have. The reason why I am highlighting franchise partners because this is an integral part of narrative, franchisee-owned company-operated FOCO. So these partners, again, quoting management, if you go look up the transcript, they are sleeping partners. And what was interesting is that the management was saying that they take a view on gold, which is like a 5-year, 6-year view on gold pricing, which also was one of the reasons why we kept a watch on the stock. And now coming back to Q1, what really caught attention was the pause in deleveraging, which the management had just highlighted 90 days before. That is in Q4, management had mentioned that they are going to do around 300 to 400 crores of debt reduction. So why a sudden pause on deleveraging? Again, quoting the management, what they are saying in this particular call, they want to focus on realizing and monetizing real estate collaterals with the bank. So instead of bringing down the debt by 300 to 400 crores, they are going to use the capital to free up real estate collateral worth 200 crores. Again, raising concerns on why free up the capital right now. One more thing that caught our attention in this particular call is that management has been talking about margin, and now they are trying to improve the margins by paying suppliers faster. Nothing wrong with that strategy. You might want to pay your suppliers faster, but if you are going to put an amount like 1500 to 2000 crores, which again the management has told, for paying their suppliers without actually quantifying what is the incremental return on capital employed. So what management mentioned that the capital employed is going to be higher than our corporate ROCs, which again raises a little bit of a concern that without quantification, why you are deploying something like a 500 to 1500 to 2000 crores. Lastly, again, Kandahar, the store which I am sitting outside of, basically it's a new generation online store, online offline store, predominantly catering to diamond jewelry. Over the last 1 year, the losses have increased by almost 5x. From 2 crores, the losses have gone up to 10 crore. Management, again, quoting them, they have mentioned that this is not their cup of tea, running platforms like Kandahar, yet they are investing almost 80 stores for this particular year. Again, raising concern, why invest where this is not cup of tea. Last thing, they already have Kalyan, which is the big format. Then they have a something called My Kalyan, which is a hyper local store. Then they have Kandahar, which is the third format. Now again, management wants to invest almost 400 crores in developing a regional brand. The same question: why deploy capital to have one more brand? So, which raises a lot of questions around the company's capital management policy. Reconnecting your thought on what is the difference between margins for Kalyan versus their peers, let's say a peer like Titan. As per call, again, Kalyan has a higher studded ratio. By studded ratio, we mean higher diamond jewelry ratio, which technically should give you higher margins, but their EBITDA margins are lower than peer like Titan. And again, the reason for this is, as per management, 43% of the business comes from franchise-owned stores. The catch here is that these franchise-owned stores are basically delivering 50% less margin than the usual store, which again is quoting from the management's point of view, that why have this expansion wherein you are getting lesser margin. So again, there's a disconnect. Asset light, lower margin franchise run business, but yet not making good margin than a comparable listed peer.
Understood. I guess one of the things that probably comes as a question here is just over the next few quarters, what operational performance would you keep an eye out on as a gauge of the company's capital allocation discipline, especially when they're expanding into new formats and new geographies?
So I think the one of the thing perfectly what is the main pain point is the promises what the management has been giving over the last couple of quarters. So it's important to keep a tab on the promises that the management has mentioned. So obviously this particular quarter the management has mentioned improvement in margins over the next couple of quarters. So a tab on how much faster that they're paying their suppliers and its implication on return on capital employed and margins is essentially critical. Amount being spent on formats like Candor again being very critical. Amount being spent on regional brands also is very critical. And interestingly, the management, as in the company, is up for its AGM, I think around September. Today is what they have released. So again, it's a good forum for investors to question management about their capital allocation strategy.
Got it. Well, thanks very much for the call today, Pranav. And listeners, check out Pranav's coverage of the company on Smartkarma and tune into our next Smart Call. Thank you.
Perfect. Thank you.